Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for this segment, we have Mark Marex, Director of Index Research and Development at Nasdaq Investment Intelligence, to discuss technicals in the Nasdaq 100 as the index has cooled off recently with less bullish sentiment and more defensive positioning versus what we saw in the early summer. Mark, it's great to see you as always. Welcome back to Trade Talks. And I think a great place to start with this is to see what the relative strength index is saying about the index.
Yeah, sure. Thanks, Jill. Great to be back as always. Relative strength index, looking at the last 14 days here. That's the gray dashed line. What I've plotted out is the typical levels that we consider to be overly bullish. That's the green at a level of 70. You can see where I kind of circled that towards the right-hand side of the chart. That's what we were seeing a lot of heading into the summer, sort of late spring, early, even into midsummer. We were seeing the sentiment get awfully bullish. Riding on the coattails of the AI wave, and just generally, right, really favorable fundamental trends for a lot of the biggest names in the index and a lot of the smaller names too. We've since really cooled off. You can see that RSI indicator recently dropped close down to that red line, which is the level of 30, which is considered usually the boundary of where things get to be fairly bearish. And then we've bounced off of there recently a little bit, kind of hovering right around 50 now. So neither overly bullish or overly bearish. The sentiment has definitely cooled off. But, you know, we're not sort of plumbing the depths here. We're not sort of seeing anything overly bearish on the other hand either.
And Mark, let's take a look at the short-term moving averages, because even there, we're just a touch above the short-term averages, it looks like.
Yeah, so this is looking at the 20-day and the 50-day moving averages in gray and red respectively. So I actually, I noted what these levels are as of yesterday's close, September 7th. We actually did see the 20-day recently dip below the 50-day, which typically is not a great sign for short-term momentum, except here, you know, if you actually were to zoom in on this, you could see they are extremely close to each other and kind of flatlined, both of them. So I wouldn't say the short-term trend is getting any worse. We're kind of just treading water at this point. And so, you know, the index in the blue there, it has kind of bounced, you know, below both of those levels, but then recently bounced back up. We did have a bit of a recovery sort of right towards the end of August. And, you know, things have gotten choppier. We've had some good days, we've had some up days, we've had some down days. Obviously, some tough news recently this week around Apple, which continues to be the biggest holding of the index at over 10%. Getting some very negative news out of China for Apple around restricting iPhone usage coming out of the government, and also potentially you know, some newer phones coming out of Apple that use some sophisticated chips that the US is looking into. To see if that is sort of in line with the recent policy around chip exports to China. So a lot of, I would say, not company specific, company driven fundamental developments around, you know, performance getting a lot worse in terms of top line or bottom line. It's a lot of these kind of geopolitical macro headlines, I think, that have recently given investors a lot of pause. It's why the sentiment has gotten weaker. And things also like the you know, the long-term interest rate outlook maybe firming up to be higher for longer with some of the recent indicators there. So that's not necessarily bullish either. So we're kind of in this wait and see period, I would say, for now.
And then Mark, what if we take a look at the index from a longer term perspective?
Yeah, so longer term, I've got the 100-day in red here, the 200-day in gray. This is some really strong support, right? We've just had an incredible first 7 months really of the year, best first half in the index's history. So we've got, you know, a decent way to go before we were to kind of hit up against that 100-day moving average. Index yesterday closed at about 15,259. We're trading pretty flat today. So right about the same level. So, you know, that's about close to 700 points above where that 100-day moving average support is. The 200-day way below that looks to be closer to about like 13.5, 13.6. So I would say longer term, definitely more of a better setup in terms of, you know, where we are trading now versus some of those support levels if we were to have kind of a deeper short-term correction.
And finally, Mark, let's take a look at options positioning volatility. I think the volatility picture is quite interesting here, considering that it has been a little bit choppy in the Nasdaq 100 to start September.
Yeah. So you look at these two and you kind of scratch your head a little bit, right? Because on the one hand, on the right-hand side, the VolQ, the NDX volatility index, it has not really shown a spike in volatility, even though we've all noticed it, right? We've noticed the days have gotten choppier. We've had a bunch of those, kind of around 1% down days, followed by some up days, going back and forth on a seesaw here. The volatility really hasn't budged all that much. It continues to be under 20, which already is kind of a pretty good level to be under, not to mention anything like a level of 25 or 30, which we haven't seen really all year long. So volatility is not really saying that things have gotten a lot more uncertain and a lot riskier for this index. But then if you look at on the left-hand side, this shows you the SIBO equity put call ratio. This is for the entire US equity market. And this showing you that recently there has been that spike up in the ratio of puts to calls. We did spike up above 0.8. Usually 0.7 is the kind of dividing line between what people consider to be, overly bearish positioning in the options market. If you're above 0.7, that means people are really interested in, getting some of that protection to protect against potential downside in the market. We saw a huge spike up in that ratio, by the way, right at year end. You can see that other circled line when we jumped up to a ratio of 1.5 almost going into year end. And then what happened? We were off to the races in January. So that doesn't necessarily mean that going forward, we're in for a period of elevated volatility and a pronounced correction. It just means that, again, given the run up we had in the first half of the year, given that there are these other kind of risks that are out of a lot of these companies' control, like Apple, like NVIDIA with China, the positioning, I think, is just a little bit more defensive, trying to lock in some of those gains from first half as we get, deeper into the second half year and ending up, making a run for 4Q.
All right, Mark, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.